The UK IPO market has been somewhat constrained in the first half of this year because of the need to navigate political events. Everybody's known about Brexit and the general election. And whilst it's not unusual for companies to debut en masse, advisors themselves tend to look for so-called IPO windows when the market conditions are supportive. We've now had a sustained period of supportive equity markets both in the UK and in Europe, and we've got that window in the political calendar, so we're starting to see that backlog of deals come to market now. And although it's been a relatively quiet year for IPOs, we have had some do very well. Alpha FX in particular, they saw a really nice IPO spike, floating at £3.25. They hit £4.48 in the first few days of trading. Currently the shares traded around £5. Not all of them have done so well. Medical device maker Convatec, we didn't actually participate ourselves, but they raised nearly £1.5 billion at £2.25. The shares came on well, and we actually thought we'd missed out. They hit £3.40 in June, but then they had a profit warning over their full year 17 numbers. And that's seen the shares drop back down below the IPO price, and they traded around £1.87, I think. October has already been the strongest month for UK listings this year by value. We've seen some large IPOs pulled despite that. TV and mobile milestone Arqiva, and also Baku, which is one of the largest providers of ready meals to British supermarkets. They've both pulled their plans to float because of concerns over the volatility of the market. Arqiva were actually due to be a £6 billion float, which would have been the biggest for the year. Baku were looking at a £1.5 billion valuation. Does that mean that the market's had its fill of new listings? We don't think so. It does, however, mean that you need to be selective. And we continue to see many smaller IPOs that we believe offer excellent value. As a team, we prefer analysing smaller IPOs. The majority of them have fewer moving parts. You do find that the complexities of some of the larger businesses, their corporate structures, etc., make valuations difficult to understand. And in some cases, that makes them difficult to justify. Even though the smaller businesses are high risk, we do find that they are generally much simpler businesses. It's very difficult for us to say why we would back something on an individual basis, but we do have several key guidelines. Often there are genuine reasons for doing so, but we are extremely wary of management teams that sell down large percentage stakes in their businesses. We would much prefer management teams that continue not only operating within the business, but that are also significantly invested. If the management team are taking all their money off the table, why should you invest? Management remuneration is also key. We often find that there is a direct correlation between conservative incentivisation and company performance. We don't like to see huge running costs for small companies. Similarly, too much debt in comparison to profits or enterprise value is also a large negative, and we like to see lock-ins for pre-IPO shareholders as well, so that they're not exiting day one at a significant premium. In the short term, a company that really impressed the investment committee was Baku. That's due to list next week. It's the world's largest independent direct carrier billing company that provides a mobile payment platform. Baku already count Apple, Google, Facebook and Spotify amongst their merchants. And when you consider that the humble mobile phone offers twice the reach of a credit and debit card network, it's pretty clear to see why big businesses are keen to utilise that as a payment method in the future. Baku have just swung into profitability, and they will be attractively valued in comparison to their peer, London-listed Bango.